Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, February 7, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had another volatile session out here. The market was up, the market was down. We're still getting large swings in both directions, and that's most likely not going to end anytime soon. As you can see today off the daily chart, we went up and we pierced through on the upside the 50-period moving average. That's the blue sloping trend line. That's where, or right above that, is where we found some resistance today, and the market actually finished poorly. So we finished on the lows today, and that really portends negative trading for tomorrow. So I put in a line at about 265.50, this thinly horizontal line running across the screen. That's the 50% retracement area from the recent pivot low to the recent pivot high from today. So your pivot low down here from the other day, yesterday, and then here's the pivot high. And this would represent about a 50% retracement. That's not uncommon. In fact, it's garden variety market behavior. So I wouldn't be surprised to see the market come down and test in and around that level. Will we get to that level? It could certainly come up short. Can we go through that level with a deeper retracement? Absolutely. I'm just putting that in as a guideline as the markets remain very volatile. So for example, with volatility elevated to the way it is now, normally 1 point in the spider is generally going to yield maybe 3 to 4 points in today's trading activity. So when you translate that to, for example, the S&P E-mini futures contract, 1 point can mean like 5 points. It could mean, big swings in both directions. As an example, we had about a 50-point range, a 50 S&P point range, or a 5 S&P or SPY point range in the market today. That's tremendous volatility. So when the ranges are that big, you have to expect that the market is going to overshoot normal levels that always would trade to. So for example, on the upside today, the 50-period moving average came in at 271.53. So let me move this chart over and we'll see where the high today on the spider was. The high was 272.36. So we almost overshot the 50-period moving average by a full point on the SPY. That is a little abnormal, and then we sold off. So if we traded down tomorrow toward the 50% retracement area, we may or may not hold the 265.50. We may have a deeper retracement. You have the 100-period moving average trading below that at 263.33. Basically, when the markets are this volatile, it's anything goes. I'm not necessarily expecting right now new lows to be made, but it's not uncommon for the market to do what's called some backing and filling from yesterday's reversal day. Remember, yesterday we were way far stretched away from home base. Home base is the 20-period moving average, so we got stretched way to the downside and the market snapped back. However, that doesn't mean we go straight up. It doesn't mean we go straight up to the 20-period moving average. Remember, there are bulls and there are bears, and they're duking it out right now. And the likely scenario is we do have higher to trade off of this severely oversold condition. Remember, the market got severely oversold in less than 3 trading sessions, so it really does need to snap back a little bit, but it's not going to happen all at once. Just to magnify the moves a little bit, I've taken the chart down to an hourly chart. So this is the same pivot low from yesterday, and this is the same pivot high from earlier today. And what we're doing is we're just retracing a part of that move, and here's that 265.50 level, and you can see it pretty clear on the hourly chart where it would not be uncommon for the market to make at least a 50% retracement of that move, and that could certainly portend or be followed by another move higher, and this would be one of our classic A, which is the A leg is up from the bottom, a B leg is down to some kind of retracement level, and then a C leg would be up, and it would complete at minimum of over the A leg high. So this is an ABC corrective pattern that seems to be developing. That's also known as a zigzag pattern in the world of technical analysis. What's going on right now in the market is very, very common in terms of how the market trades and retraces certain levels. It's obviously not common, the type of volatility we had over the last few days. That's abnormal. However, the way the market is treating what could be at least a temporary or short-term bottom is somewhat normal. Remember, it's the market's job to make as many traders and investors look like fools as possible. So the momentum traders, as the market's going up, they're buying the momentum. They're buying thinking it's going to continue, and then we hit a resistance point, we sell off, they get scared, they sell, and then the market finds some kind of an interim low and it bounces back, and there's your ABC corrective pattern. So these type of markets are not necessarily great for momentum traders. They're better for technical traders that understand these type of corrective moves. Here's the IWM, which is my favorite market leading indicator, as you know. And the IWM actually showed some signs of relative strength today against the spider. The spider was down about 8 or 9/10%, and the IWM was down slightly less than that. It's not a tremendous divergence, but yet it is a divergence. So there is some positives to this market. We can call them green shoots, as they're known. When you look at the hourly chart of the IWM, this looks more like a bullish pattern than it does an ABC corrective pattern. So we had an up move, and now we're basically going sideways, and we're holding the 20-period moving average on the IWM. Remember, the spider was stretched way below the 20-period moving average, but the IWM was weaker a while ago ahead of time, and therefore the 20-period moving average has already come down, and we're consolidating right around that 20-period moving average. We could have another move higher, at least into the 50-period moving average from where we are now. So we'll see if that develops over the next day or so. As you know, the IWM on the daily chart, or any chart for that matter, hit our top level that we identified before it got there at 144.50, almost to the penny. Pierced it by a couple of pennies. This was yesterday. The low was 144.24, and then we shot up off that like a rocket. And that level really wasn't a secret. There was a pivot low in here that was likely to hold. It was also a garden variety retracement level. You had a former gap level that had already been filled, but nevertheless, either way, that was going to be an important level on the charts. You also had a former pivot high right below that. So there was a lot of reasons why the 144.50, give or take 25 or 50 cents, was going to hold, and it did. So I'm happy to see that. And like I mentioned last night, the market still is trading very technically sound. Technically speaking, there's nothing wrong with the way the market's trading. Volatility is elevated. We had a large sell-off. But in terms of the technicals, we are trading as the technicals would dictate. Now here's the volatility index, and you can see here that the volatility index has begun to come down. We hit a high of around 50, and the volatility index came down, and even though the market finished down today, the S&P was down 13 points, the Dow Jones was down slightly, about 20 points, the NASDAQ composite was down 63 or 64 points. So while the market was down today on close, we still ended up getting some of the volatility taken away or sucked out of the market. What that tells us is, unless that turns around and the volatility spikes back up, that tells us that there likely is an upward corrective move going. And if that's the case, we're likely to see more volatility come out of this market. Looking over at the transportation average, the DJT, or Dow Jones Transportation Average, it looks very similar to the spider chart, only the transports were up today, and as you know, this is my second favorite leading indicator of the markets, and that being the case, this is also a positive sign. So my two favorite leading market indicators, the IWM and the transports, have good relative strength against the S&P 500. That's positive for the major markets, at least in the short term. Just like the other markets, the transports were way oversold. You can see how far stretched we were from the 20-period moving average. The 20-period moving average is the red trend line, and this is yesterday's low. Very far stretched away from the 20. That's home base. The market never stays away from home base for too long. Now let's take a look over at the gold market. Now gold is breaking down, so we came down to the next level of support that we mentioned last night. And we said that if this consolidation area doesn't hold, and it held today, the lows come right around where that low point and the consolidation point is, or the consolidation area. You can see here that here's the lows, and that held today, but I'm not optimistic that that's going to hold for much longer. So I think the trend is turned down. In fact, I'm pretty sure the trend is turned down in gold, and the likely story is that we're going down to test at minimum of the 50, most likely at minimum of the 100 period moving average that comes in right now at right around 1302.20. That's most likely good for at least a short-term bounce, a short-term hold. But if we get down there, I'm not optimistic that that's going to hold either. I think we're going to get some downward pressure in gold as we're seeing the dollar strengthen quite a bit. We'll talk about that in a moment. As you can see from the hourly chart, this is the 60-minute gold chart. This is really, as far as the 60-minute chart is concerned, certainly in a downtrend. You can see what happened. Look at the 1333 number that we've been identifying as important to the market, along with 1338. But here's the 1333. We broke it, rallied back right to that level, pierced through it a couple of times, not by much, and then the market just collapsed away from that level. Now we're getting a little bit of a short-term rally based on the hourly chart, but it probably won't go much past the 20-period moving average on the hourly chart. That's the way I see the gold market trading right now. Next up, we'll take a look at crude oil. Crude is also having a breakdown, a very large down day for crude oil, down about 3%, 2.9%, $1.84 in crude oil, heading right for the 50-period moving average. Does this damage the long-term uptrend and the long-term targets that we've been discussing up around $73, $74 a barrel? Well, the daily chart looks like crude is breaking down, but let's go to a larger time frame. We'll go to a weekly chart, and let's put it in perspective. So we got up close to the 200-period moving average, came up short, and now we're selling off. However, all we're probably going to do at maximum right now is go back to this consolidation area, which is a former breakout area for crude oil on the weekly chart. And what do I always say? Markets like to come back and test former breakout and former breakdown areas. That breakout area happens to coincide, at least for now, with where the 20-week moving average is. So it makes sense to me that if the market came back towards that 20-week moving average, comes in right now just north of $58 a barrel, that's where we're likely to find a pretty good level of support. That would get enough traders bearish on crude oil. We would likely find support at that area, and if it held, we would be setting up for another leg higher, and if that took place, that leg higher would take us up to $73, $74 a barrel, if I'm right about the look on this chart. So from a long-term perspective, there's really still nothing wrong with crude oil. The daily chart is starting to look ugly, and most traders don't look at the longer-term charts. They only look at the daily and beneath that. So they look at the intraday chart, and then they look at the daily at maximum. Most traders don't look at the longer-term chart. You have to look at the longer-term charts to get the bigger picture, and what it does is it clears away a lot of the noise from the daily chart, the hourly chart, and even the smaller time frames from that. Now let's talk about the dollar. We don't talk about this each and every night. However, as you can see, the dollar has gotten very, very strong. The dollar is on a rally, and what happened was once we made this bottoming tail, this is where I got long the dollar. We talked about it. Could have bought the retrace right here, and now the dollar is on its way up. We had a nice big positive close above the 20-period moving average. This was the low for the dollar as far as I'm concerned. I said it a number of times, even if we went slightly below that, there wasn't a lot of downside for the dollar from where we were. I think there's a lot of upside from here. However, it's not going to happen all at once. You'll have some backing and filling just like any other market. Whether or not we do it tomorrow or whether or not we do it in the next 2 or 3 days, we're likely to come back to test or back test, as it's called, the 20-period moving average. And if that holds, that'll be another spot for a catapult for another leg higher in the dollar. We may not come back to test the 20-period moving average. We may continue higher. But this is one of the reasons why you're seeing downward pressure in crude oil and you're seeing downward pressure in gold. You know I don't love to correlate markets. However, you can't help but notice whenever the dollar does get strong, you do see downward pressure, at least for periods of time in gold and oil. Not 100% of the time, but it certainly does happen enough of the time where you have to at least take notice. We're likely to see some resistance in the dollar right around this area, which was a consolidation and a former breakdown area. And then if we get through that, we'll go up to the 50-period moving average, and then you have the 100, and the market just steps up from there. That's the way it works. All markets act and react the same way. Doesn't matter whether we're talking about a stock, a futures contract, it doesn't make any difference. All charts trade the same way. And with that, folks, it's really everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.